Hi, Rob B here with Rob D, and you are listening to the Property Podcast. Wouldn't it be great to know what's going to happen in the future? Wouldn't it be great to be able to make plans if you knew what was going to happen in the future? Well, call us ambitious, but that's what we're going to try and do on this week's podcast.
Yes, welcome to the Property Podcast, where every Thursday property investors come to be informed and inspired. Today we're talking about how you should be investing over this next 7 years. Not to spoil it too much, but we believe that we are entering a new phase of the cycle. We're explaining what that means for you and what actions you should be taking as the years roll on. And stick around to the end because we've got a recommendation of another podcast for you. Not one of ours, which is a real must listen.
Rob, I am very happy with this week's news stories because we've got two train stories. I don't know how this has happened or who had a say on how these were selected this week. Okay, it was me. But I'm really happy that we have got these stories in because they are important. They are massive news for property investors because we talk a lot about infrastructure projects and how important they are to capital growth prospects of different areas. And I'm pretty sure everybody now is aware of the HS2 project. It's got a lot of press over the last few weeks. And that's why we wanted to bring it to your attention this week, because it seems finally that it will get the green light. Now, although it's not official, both the Chancellor and the Prime Minister have both endorsed the project. Possibly not with great enthusiasm or excitement, but basically because they're pot committed now. So much money has gone into this project already, billions upon billions, that they feel they may as well see it through. Now, that necessarily isn't always the best way to assess whether a project should happen or not, but part of me thinks it's a little bit of out for them to say that, yeah, we built it, but we had to, when they get criticism further down the line. So whether you agree with the spend or not, what I think we're all agreed with is the fantastic impact it will make for places like Birmingham, Manchester, Leeds, Nottingham, Sheffield, but also some other areas as well that may not be on your radar, like Crewe. That will become the best connected town in the whole country once HS2 is delivered. Places like Wigan, which will also be serviced by HS2. Manchester, in particular, will have fantastic links into London. Manchester Airport will be pretty much an hour to London. I think it's going to be making it one of the closest airports to the city centre of London in a weird way. So really, really positive news. Expensive? Absolutely. But the impact it will make? Incredible. And another news story, not going to go into as much detail here, but it's really positive for the city of Liverpool, is that their train network is being upgraded. A £500 million investment has been approved and the new trains are in the process of being rolled out. They will allow 50% more passengers, really modernise the network there. To be honest, it was massively needed. The existing fleet was at least 40 years old and it absolutely looked like it as well. So it's massively overdue for a city of the importance of Liverpool. For those in the southeast who are used to seeing those bright trains with the aircon and all the PowerPoints and all the rest of it, that's what's going to be coming to Liverpool. So super positive. Again, that investment into a city will make a big difference. So it's really pleasing to see two positive infrastructure projects to talk about this week.
Clearly, you are right now making the very wise decision to listen to the Property Podcast. But did you know that we are also on YouTube? If you are not yet subscribed to our channel at Property Hub UK, you are missing out. We're putting out a new video every week, and the format allows us to cover topics in a slightly different way than we do in the podcast. The most recent video that's gone up within the last week is about how to make a passive income from property. So head over to YouTube, search Property Hub UK, subscribe to our channel, hit the little bell so you get notified when new videos come out, then watch that new passive income video and let us know what you think. We might not be in the first month of a new decade anymore, but the 2020s are still fresh and new. And because of that, we've been giving a lot of our attention to thinking long term, something you should always do in property. But now seems the perfect time to be thinking about what we should be doing now to position ourselves for where we want to be in the future. A few weeks ago, we talked about how to make the most of the next decade. Today, we're going to be bringing that timeline in a little bit to talk about how you should be investing over the next 7 years. Rob, that's a weird number. Why have we chosen 7 years?
Yeah, we've chosen this number specifically because it's really important when you look at the 18-year property cycle. Now, the 18-year property cycle is an economic cycle that property follows. Not exactly, but quite closely. And you'll find that property will crash. It will fall for about 4 years. Then it will steadily rise for about 7. Then we'll have a mid-cycle wobble, which can last up to 2 years. Then you have 7 years of aggressive growth and another crash. And The reason why we love the 18-year property cycle is it gives us a strong guide to be what we should be doing and when, but also gives us confidence for what's coming next. Now, so far, this current 18-year property cycle has been pretty much bang on. Now, if this is a new concept to you and you don't understand what the 18-year property cycle is, then please do take advantage of our free courses. You can find them on Property Hub University. There's a course specifically on this subject. Or if you go to the podcast page on the website, propertyhub.net/podcast, you can find a search bar, type in 18-year property cycle there, and you will find multiple podcasts on this subject. So let's now assume you've got a decent base knowledge of what the 18-year property cycle is. We are in a critical point of that cycle. We are just exiting the mid-cycle wobble, and we're about to start a 7-year growth phase. And it's the most aggressive growth phase of the cycle. So lots of money can be made in this cycle. So we want to take you through year by year of what you should be doing in this phase of the property cycle. Over the next 7 years, we're going to guide you on what action you should be taking and when. It's super powerful. But Rob, I think it's really important to say at this point that the 18-year property cycle is a wonderful guide, but it is a guide. It's not an exact science.
Definitely. When you hear from critics of the 18-year cycle, it's normally the 18-year part that they take exception to. They're kind of right to do that because 18 years sounds seductively definite. Wouldn't it be great if you knew exactly where the turning points in the market would be? But in fact, the 18 years is an average. When you look at every cycle going back for the last 200 years, on average, the cycle lasts for 18 years. But of course, when you've got an average, that means that some cycles are going to be longer, some cycles are going to be shorter. So when we're saying, oh, well, in the next 4 to 5 years, this will be happening, and that means you want to do that, we're being guided by the averages. Some cycles are shorter, some cycles are longer. This one seems likely to be one of the longer cycles. So the important thing is not to get obsessed with the timing, because that's always a bit different, but to look at the sequence of events, because that is pretty much always the same.
So let's get into it. We're going to guide you through what to do, areas you might want to consider investing in, and also the actions you should be taking during that period. Now, the next 12 months are a really interesting time, and I think a fantastic time for property investors, because we are only just entering this new phase of the cycle. And most people, pretty much nobody, is aware of it. You know, the 18-year property cycle is not something people talk about. So the next 12 months bring a fantastic opportunity for property investors. But it won't be barnstorming. So the growth won't be enough to grab the attention of the general public. It'll just be some nice, solid, steady growth in the property market. And that means that there are still opportunities in prime investment areas. So places like Birmingham, there are still opportunities. Manchester city centre, still opportunities. And of course, areas that haven't even moved at all, where you can buy prime property in prime cities at still very, very good prices, like Liverpool and Leeds. So you've got these cities that are fantastic in terms of their fundamentals, their economic prospects, and are absolutely considered the prime cities in England. But they are still very much investable. In a few years' time, they won't be. The best times would have passed and the opportunities are gone. But right now, you can still buy prime stock in prime areas at great prices. And if it suits your strategy, you should probably consider doing so.
Now, over the next 12 months, something that's going to be capturing a lot of attention still is Brexit. The decision has now finally been made and there's some certainty around that. But over the rest of this year, there will still be negotiations going on. That means that right now we're seeing a little bit of a spike in activity because some people have got the certainty that they need to make moves that they've been delaying for the last couple of years. But there are going to be people and businesses still sitting on the sidelines waiting to see exactly how things play out. Now, we've had a lot of questions from people in the past saying, like, because of Brexit, does that mean that the property cycle will stop applying? It's not going to happen this time around because Brexit is such a massive event. And my answer to that has always been, well, if you pick any 18-year period, there's always some massive event going on. So it's not going to change the order of events, which is based on mass psychology and fundamental economics. That's all the same. But it can have some impact on the timing. So we're not most likely going to go into a full-on boom over the next 12 months while this is still all playing out. But to us, it seems like once the next 12 months is out of the way, exciting things are around the corner.
So in summary, this next 12 months is a great opportunity for the educated investor. Most people don't understand or have the awareness of what's happening. So be brave, be bold, take action. Don't wait for the media to grab hold of it and start to give it attention and other investors take notice, because those opportunities you're looking at today won't be there in a few years' time. And that really moves us on to the next phase, which we'll say is the 2 to 3 year phase. So we've got the next 12 months, and then what's going to happen the 2 years after that? Property prices will start to move. I wouldn't call it a boom yet, but there'll be really strong growth, stronger than we've had so far, certainly when we come to the third year of this next section. And you may find that opportunities in the prime city centres are a little harder to come by. Maybe not impossible, but you're going to have to work harder to get them. Absolutely, that's a given. You'll also see people turning their attention to cities like Sheffield and Newcastle. You know what? They are really interesting places to invest. And I think by this part of the cycle, people will start to be looking at them as serious options because they may have been priced out of some of the areas we've already mentioned. Another area that people will be back into by now, and this may surprise you, is London. London in this part of the cycle isn't going to grow as strong as some of the areas we're mentioning, but it will grow. And because we've had this mid-cycle wobble, because we've had this downturn, and because in real terms property prices have been falling in London, people will go, you know what, I'm ready to get back in now. So don't be surprised to hear property investors talking about London as an investment opportunity, particularly those more passive investors who are maybe investing for the first time and live in the southeast or London and feel secure about investing closer to home. So it's still a great time to be investing. Opportunities are aplenty. It's still not mass hysteria. People aren't going crazy for property, but people are starting to absolutely take note. And the economy in general will be probably doing quite well. If we've had any stock market crash, that's out the way by now, and confidence is starting to build. We'll have more certainty from whatever's happened with Brexit and the negotiations there. And all those years of stalling and putting decisions off for businesses and individuals, the excuses are out the way now. So it's going to be a really positive time period for property investment and the economy as a whole.
Let's fast forward a little bit further out now and start looking at where we'll be in 4 to 5 years' time. By this point, things should be kicking on even further. That growth that had happened in the previous couple of years will start to be picked up on by the press, and you'll start to see a lot more positivity about property in general. You'll also probably start seeing some property programs back on the TV again for the first time in a while, and you'll find it much easier to entice your normal friends and family members back into conversations about property when previously they just haven't been interested because they remember being burnt last time round.
Yeah, you'll no longer be that property weirdo. You'll be cool.
Yeah, so look forward to that. Only 4 or 5 years to go. So there'll be more optimism around. There will also, unless something unexpected happens, be another general election due around that time, which is always a point where the government does everything they can to get the feel-good factor into full swing. What does that mean for investment opportunities? Well, all the best opportunities in the major cities will have gone. There'll still be some, you'll just have to dig a lot deeper, and new areas will be coming into play. So areas like the Northeast, for example, will start to get some movement, having previously lagged. It doesn't necessarily mean everyone should pile in and invest there, but they will be coming back onto investor radars because people will be going searching for new opportunities because areas that had previously been popular are becoming saturated. Also, if you are into more hands-on strategies like flips, potentially a good time to be doing it because there's going to be good access to mortgages, there's going to be positivity, there's going to be prices going up, which will give you a buffer if you don't get your numbers exactly right. So in general, a pretty good time to be active in the market. We've pinned it down to a 2-year period, Rob, but of course it could be longer than that.
Yeah, it could be. You know, we've said this cycle phase is probably going to be longer than the 7 years we're talking about. And that's just because of everything we've seen so far in the cycle leads us to that conclusion. So this particular phase could be extended beyond just a 2-year period. It's also worth saying that while the market is starting to get quite excitable at this point, investment opportunities are still aplenty. If you buy at this point, you're not going to be burnt because you're still buying far enough away from the peak of the market. So this is a really, really good time to invest still. Yes, of course, if you'd invested a few years before, there were better opportunities, but that makes sense. There were better opportunities 5 years ago from today where we are now. So while you may look back and get nostalgic about the deals that you used to be able to get, you still absolutely should be investing if your strategy says so. You're not going to get burnt at this point unless you're reckless about your approach, which I'm sure if you listen to the podcast, you're not. But an area where you could get burnt is the next phase, and that is the winner's curse. And that's the final 2 years of the cycle where it's mad. Everybody is getting involved. Everybody is an expert on property. Remember Bitcoin and everybody used to talk about Bitcoin and everyone was an expert. I remember the guy who cuts my hair. He was telling me about Bitcoin. Now, I'm sure he'd read quite a bit, but the point at which Bitcoin got mass awareness was the point where I made a prediction that it was going to crash. It wasn't because I was a genius, it was because it was obvious. It was economics. And that's exactly what will happen with the property market. Pretty much everybody will have awareness around the property market. Pretty much everybody will have the appetite to invest. Not all will, but all will be willing to talk about it and even consider it. It's a time when the property programs are on every night of the week. It's a time that the newspapers are full of property stories and headlines. There's ways to get rich. There's new schemes to take on. Overseas property will be promoted quite heavily at this point as well, because those investors who've done all the cities, done all the big cities, have been priced out there. They'll be looking for new opportunities, and they may look further afield at more exotic locations. During this period, what should you do? Well, not invest. That's the first part. The last 2 years of the cycle, if you invest, you're going to get hurt. Now, you'll probably survive. You'll probably be okay as a property investor afterwards. And if you're investing for the long term, you'll be fine. But if you are stretching yourself at this point, it's going to hurt. Also, you may fall into negative equity after the crash. So what should you be doing? Well, if you do invest, as I've said, it should absolutely be for the long term. You possibly want to be looking at London if you're going to invest anywhere, because that's the area that will probably recover the quickest during the next part of the cycle. But if you're not going to invest, because it is the winner's curse, then you should be taking stock and you should be reviewing what you have. What portfolio have you amassed at this point? It's not all going to be brilliant. They're not all going to be 5-star investments. I can tell you right now, not all of my properties are brilliant. Some are great and some have done me wonders, and some have been dogs, and I can't wait to get rid of them. And I will get rid of them at this part of the cycle, because I know by then that people will buy anything with a yield. It's very easy to sell. It'll be very easy to get lending at this point in the market as well. And that's when I will take stock, take a lot out of my portfolio, realise the cash, realise the equity, and sit tight for the next part of the cycle. Now, we've said this is a longer phase of the cycle, so you've got to time it right that you don't go too early and you miss a lot of that growth. And that takes a little bit of nerve. And we can't tell you the exact date in the calendar that you should do this, but having awareness of the cycle will at least help you make that decision. Now, don't be disheartened if you go too early and you see it grow by another 15% before it actually does crash. At least you've got that money ready to go next time round.
The great thing about having an awareness of the phases that the cycle will go through, even if you don't know the exact timing, is that you can use this frothy period to prepare for what you know is coming next, which is the crash. Rob's already spoken about streamlining the portfolio, but for investors, mortgages are often a big part of their strategy. So making the right moves with regard to your debt is another good use that you can put this time too. For some people, this might be deleveraging, so paying down as much as you can, or if you have sold properties, using the money that you've released to pay down mortgages elsewhere. For some people, though, it might actually be increasing the amount of borrowing, because you know that there are going to be buying opportunities ahead when the crash comes, and you also know that when that crash happens, it's going to be a lot harder to borrow money than it is now. That attitude is going to depend on your attitude to risk. It's going to depend on how much ambition you've got to grow your portfolio at that point. And it's going to depend on interest rates. And we just don't know what they're going to be at the time. But the key is to be using that time, not to be buying more, but to be preparing for what comes next. Because, Rob, depending on how well positioned you are and what knowledge you've got, a crash could be an absolute disaster or the best opportunity for 18 years.
Yes, of course. The next phase is where opportunity comes. And you can transform your life at that period of the cycle. You really can if you have cash to invest. There are so many opportunities, but this is a whole podcast in itself, and we will podcast on this subject in the future of what to do after a market crash. But we've got lots to do before that takes place. You know, as we've said, this next 12 months is a wonderful opportunity for property investors. The awareness isn't there, and the market won't be that aggressive that the awareness will come here yet. It will do in the next 2 to 3 years, though, at least begin to. And those best opportunities will start to disappear. So take action. Use the 18-year property cycle to give you confidence. And know that even if the 18-year property cycle isn't exact, know that now is a great time to invest, because you've got so much leeway and so much give. Even if it's out by 3 or 4 years, you know that now is a wonderful time to be making those investments. And remember to use your knowledge of the 18-year property cycle to stay hard and fast on your strategy, because in the coming years there will be more noise around property and eventually a lot of noise, and everybody will be talking to you about property investment. But don't get excited, don't get caught up, don't get distracted by strategies that don't suit you, don't get greedy. That's when you get burnt. But lay out your strategy based on the knowledge that you now have, stick to it, and you will do very well. So it's time to share one of your success stories. You can reach out to us in different ways. You can leave a review on the podcast. We like them. You can get in touch via the socials at Property Hub UK. However you do it, we like to hear about it. And this week, Chloe got in touch on Instagram to say, "Hi, Rob and Rob and the Property Hub team. I wanted to take some time to thank you guys on the impact that you've had on my life over the last year. I discovered the podcast back in February 2019 as I was starting to switch on to property as a way to build my wealth. It's not an understatement to say that the Property Podcast has changed my life. Thanks to your advice and recommendations, I had the courage to quit my job, where I was being treated terribly, and secure my dream job, buy my first buy-to-let in Liverpool, and take the plunge to start my own business on the side. I look forward to doing my second and third buy-to-lets this year and scale my new business. I can't thank you enough for all the content you produced, and I hope to get to meet you guys soon in person. Best wishes, Chloe." Well, Chloe, fantastic. Well done. You put it to the Property Podcast, but we put it to you. You have to take the action. Lots of people consume all sorts of content, including the Property Podcast, and don't take action. What you've done is brave. What you've done is incredible. And congratulations. You deserve all the success that you've got for taking those chances and those risks. Put yourself in an uncomfortable place, but it looks like it's really paying off for you. So congratulations. Really, really well done to you. Right, it's time for Hub Extra Time, the time of the podcast where we like to give you that little bit more. We feel our job's not done until we give you an extra resource, tip, quote, something that can impact your life in a meaningful way. And remember, this is all backed up by the Hub Extra email, which has even more of this lovely stuff every single Friday. To get that email, it's completely free. Just sign up to the Property Hub and it will land in your inbox. We aim to make it the most valuable email you receive each week. Now, this week, Rob, I'm excited because you've recommended a podcast from Tim Ferriss. Now, I haven't dug into a Tim Ferriss podcast for a while because I get a bit intimidated by the length of them. It's a big commitment, but you've wholly endorsed this one. So I want to hear more about it. And then after that, I'm going to go and have a listen.
Yeah, it's a tough choice because it is 2 hours long. You could listen to 6 hours of the Property Podcast in that time. But on this occasion, I would strongly recommend listening to the interview with Sam Zell. I'd never heard of Sam Zell before, but I really should have done because he's a billionaire. He's one of the 400 richest people in the world. He's done too many things to even go into. But one of the most notable for our purposes is that he created one of the biggest real estate investment trusts in the world, which became at one point the biggest owner of apartments in the whole of the US. So he's done a few things. He's into his 70s now, and it very much reminds me of Ray Dalio, another billionaire who just seems to be in a place where he's got so much perspective from everything that he's seen over the years and wants to share some of that knowledge. There's loads of fascinating stuff in this interview, especially when he talks about what he sees the future of the markets being like and what he has to say about the role that interest rates will play in that, which is something that I don't think gets talked about anywhere near enough when talking about market cycles. So to avoid this podcast becoming of Tim Ferriss-esque length, I'll stop there, but I strongly recommend you check it out and you'll find the link in the show notes.
So that's us done for another week. We'll be, of course, back next Thursday. If you've not subscribed to the podcast, make sure you do that now so you get it in your podcast feed. And of course, we'll be back with Ask Rob or Rob on Tuesday. But if that's not enough to keep you going, check out all the social stuff we've got going on. Loads of property goodness, loads of property knowledge being pumped out by the Property Hub team all the time. Our social channels are at Property Hub UK. You can find us on Twitter, Instagram, Facebook, and anywhere else where people are being social. And of course, you've got the Property Hub forum as well. Loads to be getting on with. So until we're back with Ask Rob or Rob on Tuesday, we wish you well. Have fun. Take care. Bye-bye.
Bye-bye.